makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. It's BOE decision day. The Bank of England is expected to hold rates at a 16-year high, but will it signal when it will start lowering borrowing costs? President Biden warns he'll hold back more weapons if Israel invades Rafah. Plus, the Spanish government opposes BBVA's $12 billion hostile bid for smaller rival Sabadell. The combination would create a new Spanish banking giant. So let's take a look at the European markets map. We actually have a pretty busy day. We have jobless claims also in the U.S. We have Bank of England. And you can see the rally that we saw in the last couple of days really fade away a little bit. Now, Treasury is also slipping, so let's get to cross-asset. We had a weaker than expected bond sale in the U.S. Now, the recent stock bounce seems to be fading for a couple of reasons. First of all, we're at the end of the earnings season, and so a lot of the good news or encouraging news has already been priced in. And then maybe there's a bit of anxiousness amongst the traders. They want to move away from earnings, start pricing in what central banks will do. And again, while the BOE policymakers are not really expected to keep or are not really forecast or are forecast to keep rates on hold today, a lot of the focus will be on a dovish tilt going forward. You can see euro dollar at 107.34, and then we also need to look at pound Brent 84.20. So the Bank of England expected to keep interest rates on hold at 5.25% today. Governor Andrew Bailey may give a stronger signal on when the central bank can lower borrowing costs from their current 16-year high. So for a preview, we're delighted to be joined by Bloomberg's UK correspondent Lizzie Burden. So Lizzie, good morning. I know there's going to be possibly quite a lot of clues, we hope, or at least traders hope, from the governor about what happens next. But there's a lot of people who say, look, he was late actually to cut interest rates, and there's or to hike interest rates, and you know the other way around could also be a problem.
Yeah, it doesn't want to be behind the curve. You've already had the Riksbank, the SNB, in the pivot party and the ECB very clearly telegraphing that they're likely to cut in June. So the focus today is on when that first cut comes and then the cuts after that. I'm sure this is going to dominate the press conference later. In terms of the clues for the market, first of all, look at the language around the decision in the guidance. Do they say that some cuts are coming in the coming months? Do they follow Christine Lagarde's lead and actually say these are the data points that we're watching as a signal of whether they're going to go in June or in August? Mind the vote split as well. Does Dave Ramsden join Swati Dingra in voting for a cut? He seems to have had a bit of dovish tilt recently. And then look at the forecast. Do they push back on inflation hitting the 2% target? Do they drop inflation in the forecast, given that it's predicated on the market curve? That would push against the caution in markets at the moment. But it's really going to be difficult for them to wait till August, Francine, if inflation is below the 2% target before then, when you've got all these other central banks on the cutting path already, and when you've got political pressure from the likes of Jeremy Hunt, who's said already that it would give a feel-good factor to voters when the cuts do come.
Yeah, the concern is, of course, it's not a trend actually with inflation going down. It kind of goes back down a bit and then a little bit up. Thank you so much, as ever, our UK correspondent there, Lizzie Burden. Now, for more on that BOE decision, let's bring in Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Kim, so good to speak to you. Thank you so much for coming on. If you're a Bank of England governor right now, I mean, it's a little bit of a tightrope because you also have the elections coming, and so there's probably like a quiet period where you can't do much without it being seen as a political signal. What are you expecting to hear today?
So today, we think the forecasts are going to tilt dovish. You know, the market path. But from the last forecast meeting, it's only pricing in 4 cuts now till the end of next year. And that market path at the last meeting was showing 2.5 more cuts. So that's going to mechanically pull down the forecast. We think it's going to also show the market that it's now pricing in too little till the end of next year. As Lizzie said, we do think Ramsden's going to join Dingra for a vote to cut at this meeting. His latest speech told us that now he sees the balance of risk to disinflation or inflation to the downside. He also talked about the next print for the UK inflation number to really converge to Europe rather than the US. So I think that it makes sense for him to start voting for a cut. He has also voted differently from the internal members before. I think 3 times has Bailey's been at the head. So we think that's coming. But I think they're going to keep the door open to June or August. And there's a lot of more data to come before the June meeting.
So is there a danger, actually, that they act, too decisively? So actually that they cut by too much or that they cut too quickly? Yeah,
I think it's really down to the next 2 inflation prints before we get to the June meeting, because I think this month's a big month for the UK. We get all the annual price and wage resets going into the inflation and wage numbers. And last year, the Bank of England was really surprised on the upside to the extent of this dynamic. So they're going to keep the cards close to the chest. I think they should be patient, wait for that data, and don't give away too much at this meeting.
Again, in terms of timeline, I know every central bank will push back and say, well, I'm just setting rates for my economy, but we're so global and there's so much interaction. Does it make a difference to interest rates and, to for example, gilts if they cut after the ECB or before the ECB?
I don't think those 2 months really make too much of a difference. I think the picture is slightly different to Europe. I think Europe's further down on that disinflation path. There's still a bit more uncertainty in the UK. But I do think the Bank of England can go before the Fed. I think the narrative has been challenged a lot more in the US than it has been in the UK. And I think there are more signs here that that policy is restrictive here.
Kim, the Fed, we also have jobless claims. The Fed expectations have kind of been all over the place. What's your baseline?
We think about 2 cuts this year. I think it's really important for the bond market that Powell really torched the idea of hikes. When he was asked for scenarios, he gave us 3. 2 involved cutting, 1 involved staying on hold, even if inflation stayed persistent. But we think the Fed's going to be slower than the bank and the ECB. Growth has come off after Q1, but it's still strong, much stronger in level terms than Europe. But we do think you're going to get this broad disinflation come through the year, just a little slower than the rest.
Are we importing disinflation or deflation from China? Or, again, what's the dynamic between the U.S. and China right now?
Yeah, so I think China, we've seen a bit of a reacceleration in Q1 in growth, but it's not changing our overall narrative for the year. It's still government policy that's coming through to put that 5% floor rather than really try to boost the economy. There's still a lot of fragility there. So I think for us to believe in an acceleration from China and inflation from there, we're going to have to see something pretty different.
So, it's a complex world in terms of central banks. Is there anything that you'd be buying right now? We also had a bit of a weak, actually, Treasury auction.
Yeah, I think so. UK is our favourite market. I think versus Europe and US at the moment, everything's coming into better balance, but I don't think that narrative's fully priced yet. So you've got the labour market loosening, you've got signs of inflation persistence weakening, fiscal's a little quieter. I don't think that's fully priced in the market. And we used to like Europe a lot. I think the challenge for Europe now, though, is that, as I said earlier, it's the furthest down that disinflation path. But the ECB has also dug its heels in for June. So it's already done that dovish pivot. The new news has been kind of a reacceleration in growth instead. So it's a well-positioned market, I think kind of lacking an immediate fundamental catalyst. So our expression there is more in the carry space rather than bonds.
Is there anything in European bonds that you like, maybe play against each other?
Yeah, so from the carry perspective, we like. I think you got to be strategic between these and a bit tactical. But Spain, Italy, things like agencies. I think the news around the EU is really interesting. With it possibly going into benchmarks, that could be a big tailwind there. So carry in those kind of areas.
Kim, thank you so much. Kim Crawford there from JPMorgan Asset Management, of course, stays with us for a little bit more market insights later on in the program. Now, the Bank of England's decision comes at 12 p.m. London time, and then we'll have special coverage of that and the press conference for viewers in the UK. Everyone else can also watch it streaming on our Bloomberg TV YouTube channel, and we'll have analysis and commentary on the terminal at TLive Go. Now, later today, we'll also bring you our interview with the BOE Governor, Andrew Bailey. A couple of corporate news we need to tell you about. ARM shares have fallen pre-market after the chip designer gave a lukewarm revenue forecast for the fiscal year. That's raising concerns that the tech industry's artificial intelligence spending spree is slowing. And then later, the chief executive of ARM, Rene Haas, will also speak to Ed Ludlow and Caroline Hyde in the U.S. Catch that interview on Bloomberg Technology. That's at 4 p.m. UK time. Airbnb shares also falling pre-market after the home rental company's second quarter revenue forecast trailed the average analyst estimate. Now, Airbnb provided lackluster guidance for a second consecutive quarter, indicating that growth in travel spending will actually slow further before the peak summer season kicks in. Now, coming up, President Biden says he'll halt additional shipments of offensive weapons to Israel if it proceeds with a ground invasion of Rafah. That's next, and this is Bloomberg. So President Biden says he will halt additional shipments of offensive weapons to Israel if it goes ahead with a ground invasion of Rafah. Now, he said the potential loss of civilian life is, quote, just wrong. For more on this, I'm joined by Bloomberg's MEA News Director, Roz Matheson. Roz, thank you for joining us. So what has been, the response from Israel to the halting of shipment?
Well, we haven't had any official response from the Israeli Prime Minister Benjamin Netanyahu to this comment, but we know, of course, that Israel is quite upset about it. And certainly some of his ministers have been coming out to say that regardless of this move by the US to stop this shipment of bombs to Israel, that Israel needs to go ahead as planned with an offensive potentially in Rafah, certainly needs to go ahead with its war against Hamas and go ahead with its ultimate goal, which is to eradicate Hamas as much as they can after the attack by Hamas on Israel back in October. So very much strong messaging from some of the ministers. We've had a couple, particularly on the far right, coming out to say that Israel should really respond to the US on this. But we are seeing caution from the Prime Minister about taking on Biden directly over it. Either way, it certainly has not landed very well in Israel itself.
So, Roz, what other weapon shipments the US could actually potentially stop?
Well, they're talking about offensive weapons primarily, so anything they don't want to be sent to Israel and then used in the war in Gaza, particularly in Rafah, and they don't want those to be used particularly against civilians. So it's bombs, it's modifications to bombs to make them more targeted, more guided, anything of that nature. They're not talking about defensive weapons, if there's such a thing, basically what Israel would be using to defend itself, particularly, again, the Iron Dome missile shield or artillery and ammunition for Israel to use against Hamas. But they don't want any of the heavy equipment that might be going across into Rafah, and that's bombs and modifications to bombs. They're called tail kit, and that adjusts a bomb to make it more targeted. And some of those are on the runway, so to speak, for the US to send to Israel, and some of those shipments might not come into doubt.
But so, Roz, does this actually really change anything for Israel and this potential offensive?
It doesn't change the potential for an offensive. It might slightly change the nature of the offensive if Israel has less heavy weapons to use in that offensive, but certainly doesn't change the trajectory of the thinking really for now for Israel. They might slow down a bit because they do want those weapons ideally in an offensive, but it doesn't slow down the intent, which is to go into Rafah at some point and certainly to continue the war against Hamas. That's clear from the rhetoric that we're seeing today from Israeli officials. It might slightly change the shape of a conflict of offensive on the ground or the timing of it, but it doesn't seem to change the overall intent from Israel at this point.
But does Israel, Roz, actually worry about, I guess, condemnation from allies? The U.S., but also there have been others. A lot of the European leaders weighed in.
Well, not really. I mean, obviously, the relationship between the US and Israel is important for Israel, just as it is for the US. They're long-standing allies militarily, strategically, and economically. And there has been that long relationship between the US and Israel. But we've seen throughout this conflict the US expressing growing concern about the situation inside Gaza, Europe, and other countries also, and Israel proceeding regardless. And certainly the many, many phone calls we've seen happen between the leaders of the US and Israel haven't really changed that significantly. Perhaps they've slowed Israel down a bit. Perhaps they've gone in not as aggressively in some of the fighting that they've been doing inside Rafah, but it hasn't really changed the trajectory of their thinking. And certainly, if anything, it's hardened views inside Israel about what they see as their need here to continue their war against Hamas.
Ros, thank you so much. Bloomberg's EMEA News Director, Rosalind Matheson. Now, we're also looking, of course, at other news, and we continue with corporate news. Shares in Spain's Sabadell have jumped this morning after bigger rival BBVA made an €11.5 billion hostile bid days after having an initial approach rejected. Now, BBVA shares are slumping on the news. The Spanish government has already indicated its opposition to the takeover. Now, let's bring in Bloomberg's Tom Metcalf to get more on this fast-moving story. I have so many questions for you, Tom. First of all, why did BBVA go hostile?
It's so fascinating, right? It really comes back to the interactions in the last week or two with the banks. So, look, Sabadell has basically come out and effectively flatly rejected that offer. And the sense is maybe the two sides aren't really talking too well together, so they're almost talking past each other. And look, from BBVA's point of view, that rejection made them feel, right, we've got to go straight to the shareholders, direct to Sabadell shareholders. I mean, the irony is they made exactly the same offer that the Sabadell board has already rejected. So I guess they're just making a play that, hey, can the shareholders be more open to this deal? But it seems a very hard one to make if it's hostile like this with no improvement in the terms.
So what are the chances of this succeeding?
I think it's pretty low. I mean, you just mentioned the Spanish government has already come out. You know, this has literally happened almost straight after the statement saying, you know, they're not really that open to a hostile bid. So I think there's a lot of things stacking up against BBVA. We've had a few analysts say they don't really see at this price sort of the sort of sentiment there among shareholders for acceptance. So I think there's a lot of difficulties here. I think the only thing that might change it is if perhaps the two sides can find a way of coming back and starting talking to each other again. You know, is there any wiggle room on BBVA prices? Is this tough negotiation, or are they really sort of stopped at this point? But yeah, I don't see a route to a deal as it stands.
We're just getting actually some headlines from BBVA as you're talking, Tom. BBVA saying that the offering of shares is more attractive for Sabadell. So we'll see. This is, of course, the all-share offer for Sabadell. So I think they're putting a statement out saying why this is better.
Yeah, I think the chairman's talking to sort of media and whatnot, and obviously putting forward his side of the deal.
So they're briefing. So we may get actually more news on this. But from the Spanish government perspective, why are they against it? Or do they worry that then it's just a too large bank to regulate, or they don't want it to be hostile? Yeah,
the Spanish minister coming out and saying, I think the sense that, you know, is it good for the economy, the consolidation, slightly less competition? But I think for me, the sense is more that, you know, a hostile bid is just tough on both sides, you know, what kind of job losses might result, and also just sort of the, you know, general sense if one side isn't really into it, it's going to be a very difficult and perhaps destabilising bid deal.
Tom, thank you so much. As always, Tom Metcalf, of course, reminding us that the chairman of BBVA is briefing, so we'll see whether we have any more news from him. Much more to come. This is Bloomberg. Well, welcome back, everyone. Traders waiting for the Bank of England's rate decision. We talked about it, but also data on U.S. initial jobless claims. Now, for more on the markets, let's return to Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Kim, thank you so much for coming back. We talked a little bit about the Fed and Fed expectations, and you're expecting actually 2 cuts from them. I guess what's incredible is that the economy is so strong, but also forecasts and expectations seem to be changing so much. How do you explain this?
Yeah, I think Q1 definitely took a lot of people by surprise, and it challenged that disinflation narrative. But for us, from what we're seeing, we still think that disinflation is going to come through the year. I think we expect moderation in Q2 versus Q1. I think, and there's many reasons for that. You know, firstly, a lot of, well, at least we're confident that part of the strength in inflation in Q1 was from erratic components. Yeah. And then we think there are a lot of lags still to come in auto and housing, and wages are still confidently going on a downtrend, which should pull down inflation. And then if you look at the broad contours of the more cyclically sensitive components of the inflation basket, those are still exhibiting disinflation. So we're looking for a moderation in Q2 versus Q1.
And then the other exciting bit is, of course, what's happening in Japan with BOJ. And I mean, we had a pretty busy week last week trying to figure out intervention. How do you see BOJ behaving?
Yeah, so the statement this morning of opinions as well, that was pretty hawkish. We think that the Bank of Japan, I think, will the risks are that they will deliver more hikes, not cuts, hikes, than the market's expecting. I think what you have in Japan is strongest wage growth, wage negotiations in over 30 years. Underlying inflation's a bit more mixed, but then you've got this FX pressure that's really coming through again. Interestingly, the Bank of Japan released a paper about the non-linear impacts of FX depreciation and impact of inflation. Their threshold's about 15% move year on year, and we're right there with the yen. So they are getting more concerned. And we think they're going to have to do more than the market expects.
So again, what does that mean? What would you be buying right now? What does it mean for portfolio building?
Yeah, I think it's the overall environment globally for duration is still constructive for income, for diversification. The Fed really put a hard stop on the hikes for now. So I think it's owning markets like the UK and the US, but being underweight Japan, where the Bank of Japan could deliver more hikes than the market expects.
Okay, so interesting. Kim, thank you so much, as always, for joining us. That was Kim Crawford there from JPMorgan Asset Management. Now, we were just talking, of course, to our Tom Metcalf, who runs all of our banking coverage in Europe, and he was reminding me that the chairman of BBVA is currently briefing reporters. This is basically him sticking to them, their guns and really justifying why they're going hostile and why it's an all-shares offer. The BBVA chairman saying that their offering shares is more attractive for a Sabadell, but you can see BBVA down 5.7%. Sabadell maybe on expectations of something a little bit higher, gaining some 4%. Coming up, our exclusive interview with the chief executive of Google DeepMind on the future of AI in the UK and how the company's new tool could pave the way for a $100 billion drug.